Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at ASTS Space Mobile.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For a long time, this company was, purely an R&D story.
Right, all about engineering, high risk, and just burning through cash.
Exactly. Massive capital expenditure. But what the recent data is showing us is this crucial shift in the whole narrative.
So it's not just a development play anymore.
Not at all. We're moving from that capital-intensive development phase to an operational execution story. And that inflection point, that's the entire thesis here. The commercial validation is finally starting.
And that transition is absolutely key. You can actually see it in the numbers, can't you? Starting, late 2024?
Yeah, that's right. Q4 2024 revenue came in at $11.8 million for the quarter.
Which is a huge jump. It's a 118% year-over-year increase.
It is. But, the actual dollar amount isn't even the magic number here.
It's what it represents.
Precisely. The real importance of that $11.8 million is that it marks the first full quarter where their deals with the MNOs, the big mobile network operators, actually started turning into real monetizable revenue. It proves the model works.
It de-risks the whole thing in a way a press release just can't.
Exactly. And you also have to look at the composition of that revenue.
Right. It used to be all those one-time engineering fees.
All one-time lumpy, what they call non-recurring engineering fees, or NREs. Basically carriers paying them for development work. But now we're seeing a clear shift.
Towards what?
Towards predictable recurring service fees, the kind of fees that are tied directly to active subscriber pilots.
And that's the shift that changes the whole valuation game, isn't it?
It fundamentally alters the equation.
Right.
NRE fees are temporary, they're unpredictable, but recurring revenue. That's what high-growth telecom companies are valued on.
So Wall Street has to start looking at this less like a hardware maker and more like a high-growth service provider.
That's the idea. And you can see that signal popping up in the margins, too.
Okay, tell me about that.
Gross margin expanded dramatically. It hit 61% in Q4 2024.
Wow. Up from what?
Up from 44% the year before. And while some of that is from those high-margin NRE fees, management is also signaling some real sustainable cost improvements.
What kind of structural improvements are we talking about here?
It's mostly coming from satellite manufacturing efficiency. The per-unit cost to build one of their satellites dropped from $48 million down to $39 million.
Just in the first quarter of 2025?
Just in Q1 2025. That's almost a $10 million saving per satellite very early in the game. And that's not just a cost saving, it's critical for extending their cash runway.
Which, as we'll get to, is a huge part of the bear case.
It is. So looking ahead, the growth targets are just massive. Management is guiding for $60 to $75 million for the full year 2025.
So that implies a growth rate of, 400 to 550%?
Exactly. It's aggressive, but it feels realistic because they're starting from such a low base and are just now starting to execute on those commercial contracts.
And what do the analysts think?
Well, that's what's encouraging. The street was initially way lower, but the consensus estimate has jumped up significantly. It's now around $68 million, so right in the middle of that guidance. That tells you third-party analysts are seeing the same validation.
Okay, let's unpack this competitive moat. Because if the financials are the engine, the tech is the chassis, right? There are other players in this direct-to-cell space. I mean, Starlink is the elephant in the room. How does AST Space Mobile actually protect itself?
The distinction is crucial, and it really just boils down to one single word: unmodified.
Unmodified.
Modified. AST Space Mobile is the only company with proven regulatory-approved tech for direct connectivity using a standard off-the-shelf cell phone. No new antenna, no special chip.
So competitors need you to have a special phone.
Often, yes. Or some kind of special modem. AST solved what was, at its core, a physics problem.
Explain that physics problem.
Okay, so think about the power difference. Your cell phone is designed to talk to a tower that's, a few miles away. Signal's pretty weak.
Right.
Now you're asking that same tiny phone antenna to talk to a satellite thousands of miles away in orbit. The signal is about 10,000 times weaker by the time it gets there.
So how do they solve that?
It required proprietary methods for RF coexistence and modulation. Basically, they figured out how to stop their powerful space signal from messing with the existing 4G and 5G networks on the ground, which is a huge regulatory nightmare for everyone else.
And they've patented that.
Oh, yeah. They hold over 90 patents, either granted or pending, in these exact critical areas. that protects their solution from being easily copied.
So the tech is one thing, but the regulatory moat seems just as important. You mentioned these sticky relationships with giants like Verizon, AT&T, Vodafone. What makes them so sticky?
It's all about integration and regulatory capture. These partners aren't just putting out press releases. They've built sophisticated, exclusive test networks with ASTS tech.
So the switching costs would be enormous.
Exactly. They've invested so much time, money, and spectrum. A competitor can't just walk in and take their place. The MNO would have to rip everything out and start from scratch.
And the regulatory side.
That's the key overlay. AST has secured exclusive pilot waivers from big bodies like the FCC here in the US and Ofcom in the UK.
So they got the first mover green light.
They did. While competitors are still stuck trying to navigate the maze of spectrum rules, AST is already operating at scale. And that lead translates directly to market position.
How so?
Well, even with their initial relatively small Phase 1 constellation, it can support over 3 million users. If you look at all the active D2C trials happening by subscriber footprint, they already have a 67% market share.
And we're seeing that translate into real commercial moves now.
Absolutely.
Yeah.
The Verizon pilot went live for over 1 million customers in some U.S. metro areas in February. Then Vodafone confirmed they were launch-ready across Europe in March. These are real steps toward mass monetization.
Okay, let's shift gears. Let's talk about the downside, the financial reality that hangs over any capital-intensive space company. What does the balance sheet look like right now? What's the runway?
This is where we have to be cautious. The financial health is manageable for now. As of the end of Q1 2025, they had about $427 million in cash.
Against how much debt?
Against $218 million in total debt. So that leaves them with a net cash position of around $209 million. It's a decent cushion.
Building and launching satellites is incredibly expensive.
Yeah.
That cash disappears fast.
It does. Free cash flow is still negative because of the high capex. It was negative $186 million for all of fiscal year 2024.
But is that getting better?
It is, and that's the positive trend. The FCF burn improved a lot in Q1 2025. It came in at negative $32 million, which is way better than the negative $58 million the quarter before.
So what's behind that improvement? Is it sustainable?
It seems to be. It reflects two things. One, they're tapering off the biggest spending for the initial Phase 1 rollout. And two, it's that satellite cost reduction we talked about. But even with that improvement, the biggest risk is still looming, financing Phase 2.
Right. Phase 2, that's for true global scale, and it means 10 more satellites. What's the price tag on that?
The estimate is well over $350 million. So if you project the current cash burn forward, their existing runway probably lasts through the end of Q4 2025.
Which means they'll need to raise money.
It raises the very real possibility of an equity raise, which means dilution for current shareholders. That could be coming in the first half of 2026.
And that risk is probably what's keeping the stock at a discount. What other options do they have besides just selling more stock?
Well, that's the crucial question. They'll want to avoid major dilution. They could try for secured debt, convertible notes, or, and this is the big one, they could have strategic partners step up.
So like a Vodafone or an AT&T could invest directly.
Exactly. If one of their MNO partners who benefits so much from this took a minority stake or even just prepaid for service, it could solve a huge part of that capital gap.
Okay, and beyond the balance sheet, what about regulatory risk? They have the US and UK, but they need the whole world for global scale.
For sure. Full global commercialization depends on getting approvals from bodies like ECTEL in the Caribbean and others all over the world. Delays there could push back full monetization past 2026.
But the current guidance doesn't depend on that, right?
Correct. The risk is mitigated. The 2025 guidance is based on a limited rollout, so delays wouldn't cripple them, just postpone that peak earnings potential.
Let's pivot to the technicals then, because this whole fundamental shift we've been talking about, it has to be showing up in the charts. What's the market momentum look like?
The technical picture is highly bullish, actually. The stock has been carving out a very clear ascending triangle pattern since late 2024.
And it broke out.
Confirmed a definitive high-volume breakout above the $29.00 resistance level back in March. That suggests real conviction from buyers.
Okay, but a breakout in March is a while ago. Is there anything that suggests the uptrend is sustainable?
There is. We got that confirmation back in January with a classic bullish signal, the golden cross. The 50-day moving average crossed above the 200-day.
A pretty widely followed indicator.
Right. It suggests this isn't just a fleeting spike, but that a long-term uptrend is really establishing itself.
And when you combine that with what the big institutions are doing,
It gets much harder to dismiss. The 13F filings show massive institutional buying in Q4 2024. BlackRock increased its stake by an incredible 147%.
147%. Wow.
And Vanguard boosted its position by 89%. This isn't retail speculation. This is big institutional money piling in.
Any insider activity?
Yep. The CEO personally bought 50,000 shares in January at an average price just under $20. Insiders only buy when they have very high conviction.
So with all this attention, let's nail down the calendar. What are the big catalysts coming up that could keep this moving?
We have a really packed calendar coming up. First, May 7th is the Q1 2025 earnings report. Consensus is looking for about $21 million in revenue.
So hitting or beating that would be a huge confirmation.
It would solidify that aggressive ramp-up we're expecting. Then, just after that,
May 14th, Investor Day.
that's arguably the most critical event for the long-term story. They're expected to detail the Phase 2 timeline, which addresses the CapEx risk. But the real meat will be the ARPU targets.
Average revenue per user.
Exactly. Analysts need those numbers for their models, and strong ARPU guidance could trigger some serious price target upgrades.
And then looking ahead to June.
June is the Mobile World Congress. They're planning a big demo there, a live handoff with 5 different operators at the same time. This is also where we might hear about new multi-operator deals being signed.
Okay, before we wrap up, we have to touch on the speculative stuff.
Right.
The unconfirmed chatter that could be a huge wild card.
Right. There are 2 big rumors floating around that, if true, would completely change the financial risk profile overnight.
What's the first one?
First, there's market talk about potential contract discussions with NASA for a $150 million contract.
For what?
For emergency 9/11 backhaul in remote areas. A government contract of that size would be massive validation.
And the second one is defense related.
Yes. There's unconfirmed speculation that the Department of Defense is looking at the tech for tactical communications in places like Ukraine, using it where terrestrial networks are unavailable or compromised.
And why are these rumors so important right now?
Because if either of those deals come through, that $150 million plus could solve the entire Phase 2 financing gap we were just talking about. It could eliminate the need for that shareholder dilution in 2026. It's the biggest financial wildcard out there.
Okay, so bringing this all together, what's the investment synopsis?
It's still a highly compelling story. The market has priced in a huge risk premium, so AST Space Mobile trades at a significant discount. We're talking roughly 70% to its peers like Global Star or Iridium.
That discount made sense when it was just an R&D venture.
Right, but it's shrinking fast as they prove out the tech and the revenue starts to accelerate. The long-term opportunity here hinges on them going from serving a few million users today to potentially 1 or 2 billion globally by 2030.
So this is very much a multi-year execution story. The initial upside is really tied to those upcoming earnings beats and getting confirmation on that Phase 2 timeline.
The key takeaway is this. The market discounts the stock based on future spending, but every time they beat on revenue or announce a strategic deal, that risk gets smaller. You have to consider how the growing global need for this kind of connectivity, especially for defense and emergencies, could just accelerate everything.
We will certainly be watching for those catalysts in May and June. Remember to subscribe for more in-depth analysis from us every weekday.